Welcome back to the TD Ameritrade Network. I'm Oliver Rennick. We got to talk here about today's action. Scott Bauer is here with us in studio. He's the CEO of Prosper Trading Academy. So Scott, it's ugly out there, all right, and it's only getting uglier as we get closer to the close. It seems like we're having trouble. Maybe a little bit of bounce there just a few minutes ago, but I mean, we just heard from Joe Cusick. He describes it as presumptive moves by the market, assuming that this is going to get really bad. How would you describe it? Do you think that's fair? Are these moves presumptive about how bad it's going to have an effect?
I think they are right now. Yeah, earlier in the week, not so much, but right now, I think with what we're seeing with China basically shut down, right? That economy has basically come to a halt right now. I think people, investors, retail is starting to realize that, you know what, whether it's a week, a month, 3 months from now, it is going to affect GDP across the world. So I think people are trying to get ahead of it now, probably a little bit late. You know, Scott, you and I were just talking, you mentioned a minute ago, you know, if China had come out 4 weeks ago and kind of gotten ahead of this, we could be in a different spot right now. But I do think the market is trying to, maybe a bad term, trying to catch lightning in a bottle here and anticipate the worst.
Now, it might have been a little bit more steady, right, if we had been cheaper, if this had been like, you know, the bottom in 2018 and this thing hit, you know, who knows, or maybe it would be recession, I don't know. But the idea here is we don't know anything about it. That's why it's tough to cover from my perspective too, and I think any market analyst or you know, narrator, if you will, because it's just, we have no clue. We have no clue, right?
No clue.
So how do you go about that as a trader? Do you want to even take bets that crude's overdone or copper is overdone? Because even though they're both at nice spots on the chart, we could get more cases overnight, and so far the evidence is that they are going to go lower if that happens.
You know, the bottom line is, again, a week, a month, 3 months from now, there will be an unending amount of people that are Monday morning quarterbacks and said, shoulda, coulda, woulda. Yeah. I knew this was going to bounce. I knew this was going to do that. But when you're in the heat of it right now, and technical and fundamental analysis kind of gets pushed to the wayside a little bit, there's an old adage that sometimes the best trade is no trade at all as a trader. Now, if you're an investor and you were looking for a pullback in the market, you know, there's so much money on the sidelines. People were looking for that 3%, 5% pullback. Now we're getting a little bit of it. That doesn't mean you go all in. Maybe you allocate a little bit of what you had on the sidelines now. But as a trader, man, again, I've been doing this 30 years. I know you guys have been doing this a long time. Sometimes that best trade is no trade at all.
Yeah,
absolutely.
Right now, in case viewers missed it, the U.S. is talking about right now, the health secretary is discussing what happens for those returning from mainland China within prior 14 days. If you're returning from mainland China, undergoing health screenings at selected ports of entry, subject to 14 days quarantine if you've been to Hubei province. So look, the stream of news headlines is not abating right now, Scott.
Right.
And I think what we've learned over this market throughout this bull cycle, especially over the last really 4 years, I think, is this process of realization, panic, and then recovery. Every step happens faster now, right? Look at this, the drop in December. Yeah. The fastest drop since the depression for that month in December. And then boom, pops right back, right? The problem is that, or not a problem necessarily, but a lot of people kind of get stuck in one phase. And that panic phase sticks more, right? It's just kind of our instinct.
Right, and I think Scott had a point where he said, well, you know, you guys have been in this industry 34 years ago. That's not how the markets reacted 34 years ago. But now in this socially driven media type of situation where every time you turn on your phone, you look left or right, everybody's talking about this. And the problem is, a lot of times in social media, it's not all factual, it's a lot of it's opinion. Right? And of course we get sensational headlines, but you're absolutely right. It's all coming to us at one time, and it has almost a self-fulfilling sort of snowball effect, right? So in other words, one company sees the tweet that, well, this company's going to close stores. Well, then we better.
Well, nobody wants to get caught flat-footed.
And there's almost like social pressure on you. You get shamed if you don't close. You know, there's a lot of dynamics that are working now to sort of affect the markets. And again, that uncertainty is there. One thing you can do as an investor is go back and look over the last 4 or 5 viruses that have sort of had this type of scenario play out. And I think we actually have a graphic of those things.
Yeah, if we can pull that back up from yesterday from Nick's team.
Yeah, that was a great graphic we had this week. And then that shows you, you know, if you look at these the peak to trough move of the markets during these viruses, and it's been about an average of a 5% drop, right? Well, that would put our Dow at a
that means we got about 2%
27.9,
yeah.
27.9 in the Dow, and 31.75 on the SPX. So we're not that far off. But here's what's interesting: look at that graphic 6 months later, right, and see what the market did. The markets, on average, were up like 10% after each one of these. So again, I think you're right. We're seeing a compression of what we've seen in many of these others. But will we see the recovery as fast? That's what we don't know.
I loved another graphic. We don't have this, but I'm looking at it on Twitter right now from the folks over at Global X ETFs. One of their analysts tweeted out a tracking basically of how quickly this thing was sequenced. So from a genomic perspective, WHO confirms the virus, and then the gene sequence was published. I believe it was overnight, within the last 48 hours at least. So that took basically 8 days. The difference between that and SARS, it took 63 days. So a more complex, disease as well, and a more deadly one. But even the spread between the confirming that this thing exists to then being able to map it out suggests that maybe that cure will be able to come faster as well, or some kind of treatment, or better screening processes. Again, we are not experts in this,
no.
But Nick, to come back to your guys' analysis of the risk on this, I imagine to a certain point you have to be careful how much you get overextended on assuming downside because of this.
Yeah, Scott makes a good point. We did some looking at this. Both Scotts, I love when you guys are balanced. So
can't go wrong.
There tends to be a quick rebound, right? But we don't know. We haven't seen one of these things really become an epidemic, right? And I think you look at mortality rates. Ebola certainly is the scariest of all of the things that have had outbreaks. This is nowhere near approaching that level of mortality, but there's a higher infection rate, and it seems at a small sample size that the mortality rate is higher than some of the other, particularly SARS and the swine flu. So, it kind of fits in the middle of a range in terms of transmittability and mortality. And you hate to just be statistical about that, but if you look at it on that level, it kind of fits in the middle. China's been out there saying, there was some really good reporting in the New York Times that I listened to, and I thought it was fascinating that they've done so much to improve their responses to things like this.
Let's hope.
And then when it comes out, you're hearing kind of the opposite of that. Well, it was sort of festering somewhere for maybe a month or more, so we just don't know how long it's been out there. So is the trajectory of infection really as high as it's saying, or has it been going on longer than reporting has been out there? And we just don't know. But I think, my favorite point you made is all the volatility cycles are compressed nowadays, right?
Absolutely.
And you see the reporting that we have up on the screen. You wouldn't be getting real-time footage of people getting their temperature taken 10 years ago in China, right? And you just wouldn't know, but it was probably happening, but we wouldn't know. And I think the information is so accessible now, the markets just react really, really quick. And as soon as we hear something that says, hey, it's under control, we're probably going to see some kind of pretty significant rebound from this. But it's reacting very quickly to the news that comes out.
Well, the bottom line, investors has to ask themselves the question, is the market behaving rationally with the information we have? And I make the case, no. I think the market's overreacting. And again, it's a tragic event. Nobody wants to see anybody die from a virus, but there's 34,000 deaths in the United States alone each year related to influenza viruses. We're talking about 200 people worldwide, but yet this has moved the market down almost 5%. So again, that's not rational in logical terms.
It's unknown, right?
Well, but every virus has been unknown, right? But and again, the same effect. This is not a virus that kills 90% of the people. It's 2% of the people right now, and those are elderly and infants.
Right. For SARS, though, you've got a totally different backdrop for China as well at the time, right? Pretty different from now, where this is the critical point. And Scott, I know you want to jump in too, because the critical point here is that it's China. It's basically was the linchpin for this recovery story we were talking about. The U.S. economy's been stable. It was China that needed to come back and lift the manufacturing of the world basically out of that rut. And now nobody is, I'm not going to say nobody, but the market is saying that probability has dropped drastically. So it's basically, how much do you think the probability of that has dropped?
Well, I think that it has dropped, and there's no doubting that this is going to affect our economy. Now, is it going to affect it for a month, 3 months, all of 2020, beyond? It's the unknown. And the biggest thing in the marketplace right now, what drives volatility in the marketplace is the unknown of any event. Think about just a company reporting earnings, right? Why does volatility go up? It's the unknown of an event. Once news is out, things calm down, people react more rationally. So right now, you are seeing so much activity in this marketplace that is psychologically driven, not fundamentals, not technicals, psychologically driven. It's a very, very tough trade.
Leaping ahead of the fundamentals, right? Because some of these cases, hey, I know Delta's or airline or something, Starbucks, Luckin Coffee. I'm going to say probably next quarter this is going to show up somewhere on a line, right?
Sure.
But then as you go down to different parts of the economy, that stretch gets further, right? Yeah. The stretch of the logic gets further. Scott, anything you want to
I was just going to say, you can almost think about the market's reaction to this virus is almost like VIX itself. VIX itself is what we call a mean reverting product, right? So in other words, there's always fear. We go up, we don't know what's going to happen, then we get a solution, and guess what happens? Comes right back down.
So do you want to sell VIX at 19?
Well, that's just it. We don't know how long it's going to last. And like Scott said, we don't know the degree of what will be effects to GDP worldwide. My only fear is that the market is what's taking itself down, not the virus. It's the market being so wound up in the social media and the headlines and trying to do what's correct is that by shutting down airlines and travel and stores and all these other things, it could be a self-fulfilling prophecy.
Don't forget, World War III was supposed to start at the beginning of the year with Iran, to your point. That was such a story that got so fast.
What was that?
Yeah, well,
did that really happen?
Right.
I mean, it's
so now the VIX
news.
basically is back to a period throughout the middle of last year, Nick, when the manufacturing numbers were bad. Everything was turning lower.
Right.
So does the VIX deserve to be that high?
I almost got my VIX point in before you.
Oh, did you?
But if you look at the curve.
It's like a riddle. How many options traders in a room?
The VIX is almost flat across the board at 18, all the active months, right? You go out 260 days to get to a VIX future contract that's trading above 18. They're right dead flat. Last week we were talking, and it was like front month was 12 again, and then we saw 18s out at like a month, and now we're basically flat. So we just the curve.
There it is, right there. We're looking at the VIX curve right now.
It's really quickly flattened out to be 18 now is the deal, and we're not seeing sort of back months spiking up, saying, well, this is going to be a really sustained thing.
Yeah. Here with us in studio, Scott Bauer still with us, joining in studio. We've also got Scott Connor and Nick Dieterakis. So Scott, to back this point to Nicole, because sometimes what I try and do is look to see if I can describe kind of what the narrative is bent towards, right? If there's an obvious, very far consensus in something, to try and point that out. And while right now I would say generally that consensus is that this has probably gone a little bit too far from the pool of people we speak with, there's a whole other side that was already bid up in bonds and gold coming into coronavirus that didn't make sense already based on what I thought the data trends were showing, the earnings are showing, that was a little bit suspect, that didn't line up with stocks. So for that camp, they basically feel like they've been confirmed and that recession is now imminent.
So what I think you have to do there, and I don't know the answer, and I don't know who can actually break this down, were they confirmed because the market was top heavy and that we're getting the natural, just kind of 2-3% sell-off from there that has accelerated because of this external thing called coronavirus right now?
Yeah.
It's very hard to separate how much of this sell-off is due to the virus, how much of it is due to poor guidance in some of these companies, how much of it is due to the hit that the overall market, overall global economy may take due to this. Now, when I look at Apple, or I look at a WDC or some of these chip makers who these brands have been on fire for forever here. Their reports are great.
Yeah, their guidance was great.
Guidance great, report is great.
Totally.
So,
down anyway.
How do you separate, okay, this company is on solid footing. They're expected to make X moving forward. However, we have this unknown, again, this rearing its ugly head, this unknown. Is Apple down 4% today because of coronavirus? Probably.
Okay.
Probably. So when someone says, Nicole was just talking, all these people that want to come in and buy the market, which I think, this is probably a buying opportunity. Again, those Monday morning quarterbacks. You come in, but you have to do it very, very carefully. You have to do it tactfully. There's never a point where I'm all in, right? You've got to just manage that along the way. But some of these companies where you look at the fundamentals, I got to think that it's a good place to buy. Now, Caterpillar to me is on the opposite end, okay? Because Caterpillar did not report good fundamentals. Guidance is lowered.
Bad guidance.
Bad guidance. Okay. Now, I don't think we're going to see a big drop off in Caterpillar for the reason that, and I know I'm going all over the place here. The reason that
it makes sense.
They're at a 12 times PE. They're paying a 3% dividend.
Yep. They had been riding this reflation trade until this situation.
No doubt. And with rates not going anywhere except more than likely, steady to lower here, people are looking for dividends. Yep. So in Caterpillar's case, I like the stock only for that, not because the fundamentals or the guidance, but because of that. But some of these other stocks, the Apples, the in the tech sector, who are just as healthy as could be, it's a different narrative.
I think this brings up an interesting sort of actionable question, which is, how do you generally, as a trader or investor, have a system for looking at events like this, coming up with your list of, your watch list, basically, whether it's stocks, whether it's sectors, whether it's thematic styles, whether it is commodities, right? Across asset class, and go, boom, that's the one I want now. If I want to start playing the bounce back of this coronavirus-driven sell-off, where do I begin? My first inclination would be crude, and it would be with copper, because these two, maybe bonds too if you want to short bonds, but who knows, because now the bond market's trying to force the Fed to cut again. That one is the most glaring in my mind, but copper and crude are right behind it. We are on the very bottom lows of ranges, and I imagine if something's going to bounce first, it's probably going to be those.
Yeah, and this is a really interesting time for options traders right now with two of the things you just mentioned. If you think either of those two commodities are at or near a low, you don't have to just pick that this is the low. You can go below those and sell put spreads, have defined risk with high probability that if they turn, and give yourself some cushion to be wrong and still be potentially profitable. But there's one other thing I think was an interesting takeaway today, and tell me if I'm off base on this, but I almost wonder if it was so much the virus that drove the markets today, and here's why.
Yeah,
you saw VIX much higher, right? And what is VIX based on? It's based on the S&P 500. It almost was more of an equity sell-off today than anything else, because we didn't see gold was down most of the day.
I'm with you on that.
Gold was down most of the day.
So gold a long time
Bonds really didn't rally that much. Bitcoin was down on the day. So people...
I would correct you on bonds. Bonds had a strong showing, I think, by the end of the day.
By the end of the day, but the early part of the day when we were down,
totally. I'm with you on gold.
they were very weak relative to what, and gold, like I said, down most of the day. So the fear wasn't going to safe havens, but they were selling stocks. So I almost wonder, in addition to the virus, if this wasn't a little bit of what we used to call on the trading floor, sell the news, right? So you had Microsoft and Apple hit earnings out of the park, right? Couldn't have been any better. I mean, no one could have imagined being better. Those stocks are down, right? They didn't start that way, but once that news got out, and even with Amazon, we still sold off. So I almost wonder if there's a little bit of a sort of a valuation correction going on here, in addition to the virus concerns, kind of bringing everything down.
I just want to jump to bonds real quick, though, because we did end up at a 1.52% 10-year yield. So we are now, the low in September is 1.45 basically. So we're getting close to there. But to your point, we were just having up, one of my favorite charts was the gold bond correlation. Bonds were later to the game in the coronavirus risk-off move. Gold went first, big time, even before the virus hit. So that, I think, will be important to watch, too, because gold had a little bit less gusto today, where the intraday high, look, on a closing basis, solid for gold again, but on an intraday high, we haven't taken back the Jan highs, too. Nick, what do you think about this? Because keep in mind, Chicago PMI, weak, bad, real bad. Maybe it's Boeing, but at the same time, the dollar got smoked today, which is a little bit weird when the dollar has been trading more like bonds and gold as a safety play over the last year.
This morning on Fast Market, Mr. Kevin Hinks told me I should not be basing my trading strategies on a weak Chicago PMI. So I don't know, but I'm glad you bring it up, because it was a bad regional number, right? It's a regional number, and it doesn't probably dictate, we're not down 2 S&P% on Chicago PMI, right? But there's some weakness in regions around the U.S. We've been saying this, I don't want to talk out of both sides of my mouth, but you kind of have to, from when you're looking at like what is the trading strategy through this. And I think the thing that I keep going back to, you look at the bond trade, you look at where yields are, we're getting back down to those low levels. We saw some quick, yield curve inversions. Again, people aren't really talking about that now. We saw the curve invert a little.
Oh, we're talking about it, baby. And it's back.
And then you think about what this is going to do to really stall business investment. I feel like a bit of a broken record. I've been saying this, but we can't have these valuations continue if companies aren't investing in themselves and turning that into profits. Amazon, we're not even talking about Amazon, right? The news of the week, financially, Amazon, crushed earnings. They're up, even with today's sell-off, they ended up almost 8% on the day, right? Like so over $100 up on the day, and they've invested in their business and they're up. I mean, they're up big time from that, right? So it's a little bit of a model of how investment in your own infrastructure and your company can
pays off.
But if this really slows things down, right? And I do think there is a fear where we have more pullback because the earnings are okay, but they're not there, and we're not doing really well from a revenue standpoint. A lot of companies are sort of just in line or missing on revenue. And if you're not generating new sources of revenue and you're not spending on your own business and you're not really pushing your business forward, and it's all sort of cost-cutting measures, that can only take you so far.
Yeah.
If this is a reason for more individual business slowdown, I think it could play into a bigger kind of.
And again, to Kevin's point, Chicago PMI is not a market-moving event usually, but when we're already worried about China's comeback getting halted by the virus, last time around it didn't really matter what happened around the rest of the world because the U.S. was rock solid. And then this comes into question, well, what if we're not as rock solid this time around? How long can China and the rest of the world economy freeze and we count on people to keep spending, right? How far can Lulu pants take us? That's the question now. No, I mean,
these are great.
Yeah, there you go, Scott Bauer.
These are great.
Give me a parting thought, Scott Bauer, right? Because the 10-year and the 30-day we just saw is literally going to end this week like at zero. So we're almost back to that recessionary inversion signal.
That the range has played out for 12 months, 18 months in crude, it's played out in bonds, and the range has been your friend. At some point, the range is going to break. But if I'm, choosing one side or the other here, both in crude and to the 10-year, I've got to go to the range, right?
So you sell bonds and you buy crude?
Absolutely.
I love it, Scott Bauer.
However,
boom, sticking his neck out on a Friday.
I am sticking my neck out going into the weekend. You have to. Now, that doesn't mean you just do it all out without any stops. You do it with options. You do it, Scott, as you said, with option spreads, especially at a time right now when volatility is so expensive. And if you're selling downside put spreads in crude, you're able to capture more premium because volatility is so expensive. That's the beauty of using options in especially a time like this when you do have some technical or fundamental basis to make that decision, not just the irrational or psychological trade.
I love it. Perfect note to end on. Scott Bauer. Some really nice, useful stuff here for those trying to figure out what to do. Nice work. CEO of Prosper Trading Academy. Scott Connor. Nice work, too. Scott's both holding it up here. And one Nick Theodorakis. Pleasure to have you guys all here with us on Friday. We've got a lot more to talk about. George Tillis is going to dig through some of the dirt and find some companies that you missed in all the action.